start off here, I guess, with what your expectations were heading into this morning, Michael, and whether the data that we got today changes any sort of thesis at all.
So like your other guests that were just speaking, today's number came very close to our expectations. So not only the headline and the core, but a lot of the pieces in terms of core goods, rent, and services ex rent all kind of coming in line. So no great surprise despite all the build up to today's number. In terms of what it means for our outlook for Fed policy, we have been expecting 25 basis points at the next meeting. Given that we haven't had big surprises in the CPI or the employment report last Friday, we're still pretty comfortable with that expectation. And then you mentioned, just over the past 24 hours, hearing from, both Collins and Harker tipping their tipping their hand to 25. I think that gives us a little more confidence. I mean, it's not all, I don't think it's, a lead pipe lock, but I do think it's certainly feeling like that's. Well, we're comfortable with 25.
All right. Well, there seems to be enough here, at least in today's report, where you could kind of make an argument that there has been, I guess, a relatively consistent trend here of inflation moderating here. Is there anything, though, that you saw in the report today that might give you a little bit of pause? The idea that there are some elements of this that might still be sticky?
Yeah, so, one thing I'd say is the past three reports we've seen big declines in goods prices. And just like the goods inflation was perhaps transitory, I think the disinflation that we're seeing in goods is also transitory. So I don't think we can really take that kind of part of the number to the bank in terms of expecting that decline in goods prices going forward. The rental inflation is sticky. However, there are enough leading indicators suggesting that should roll over sometime in the second or third quarter. The other things outside of rent, the other services that tend to be sticky, those were probably still a little firmer than the Fed would like, but not terrible, and certainly a lot better than we were seeing last year. In terms of what's sticky is I think the labor market, and I don't think the Fed is going to rest easy, even though they're certainly going to welcome these numbers, but I don't think they can rest easy until we see a little more softening in the labor market and then wage inflation come down with it.
Well, that's what I want to talk about, because it seems like if you look at what's happening in the swaps market, outside of what's going to happen next month, you did see the hint at pricing that maybe the Fed isn't going to hike at all at March's meeting. So when you put this number together with what we got out of the labor print, I mean, I know that average hourly earnings were a little bit softer than expected, and the market really ran with that. But when you look at the continued resilience in the labor market, what's the read-through to inflation and the stickiness overall of inflation?
Yes, I think the read-through is that wage inflation is still high, and when that happens, it's it usually coincides with stronger inflationary pressures in price terms. Now, I do think last Friday's report, there are some hints in there that payroll growth should slow in coming months. Now, for them to pause in March would mean that in the January and February reports, we see a really steep slowing in payrolls, probably more than we're expecting. So we do think they hike in March, just because we don't think the job market is going to roll over that quickly. But as I said, we do think the general direction is toward a softer job market. And as I said, I think there were some hints of that in last Friday's report as well.
I'd also love to get your thoughts on financial conditions, because that's been a real topic of conversation, especially after we got the minutes from December's meeting last week talking about an unwarranted easing of financial conditions could complicate the Fed's job here. And when you think about the fact that financial conditions, at least according to Bloomberg measures, to Goldman Sachs measures, they've been easing. So maybe not from 9% on annual CPI to 6.5%, but in the path to 2%. How much of a problem is that?
So it's enough of a problem that I don't think that the 25 at the next meeting is a lock, right? I think part of the fact that, part of the reason I'm not entirely confident is because as the dollar keeps moving lower, this is undoing some of the tightening that the Fed had engineered over the course of most of 2022. Now, as Powell said in December, they're not going to kind of micromanage this and look at daily changes. But if in the broad sweep of things, they see that tightening undone, it either means they can't step down to 25 or that the sequence of 25s is going to be longer than would otherwise be the case. I think it'd probably be the latter, but I do think that's a risk right now if we continue to see what's going on in markets persist.
Are you still in the camp, though, that the potential for a soft landing remains?
think it's certainly a possibility. I think as we discussed recently, our expectation is that the economy will slip into recession late this year, but I wouldn't rule out the possibility that we can see enough disinflation without actually slipping into a contraction.
And what magnitude of a recession would need to come in 2023 to see the Fed actually cut rates this year? Of course, we've seen the market price that in, but Fed speakers, they've been pretty clear that they don't plan to necessarily lower rates this year.
Yeah, well, yeah. The reality is every time we've had a recession, the Fed cuts rates, and they usually cut rates, pretty early in the recession. So. If we do, in fact, slide into recession, I think they're going to be easing. Maybe they won't be quick to ease because there may be some worries about inflation expectations not completely returning to the pre-inflation, whatever it was before this episode. But yeah. I think, I do find it a little curious, their rhetoric that's so, strongly pushes back against the market expectation of easing, particularly when the Fed's own staff is saying there's about a 50-50 chance of a recession this year. Of course, you got to price in some probability, I think, that the Fed could be cutting rates later this year, even if it isn't your base case.
The base case here. I am curious, just real quickly, when you look forward here, Michael, at some of the economic data that's on tap over the next few weeks here, particularly in the context of consumer spending and the resiliency that we've continued to see, what's your general outlook there? Does that begin to moderate as well as the Fed sort of gets to mission accomplished?
Yeah, so we do have a retail sales report, I believe, next week. Maybe a little soft, could be partly dented by weather, but I think there are also some indications that consumers were softening toward the, as the fourth quarter, as we went through the fourth quarter. I do think you may get a temporary relief here in January as those big cost of living adjustments, the Social Security checks, gives a little spending power to consumers. But I think as we step back and look at the big picture, if indeed the labor market slows as we expect, then nominal labor income growth will slow, and I think consumer spending will slow.